Hi, this is George Fieldhouse with Vector Financial Solutions, and this is a short presentation on how you can set up a separate private equity account. So instead of making extra payments into your mortgage or getting a shorter term loan to build equity in your home a lot faster, I'll show you how you can separate that equity from your home, either by refinancing into a longer term, getting an equity line of credit, pulling out as much equity as you can from your home, and putting it into a private equity account. And so we'll take a look and see how that works, what the advantages are to that, and just how you can set that up. So a lot of people today with the low interest rates are thinking about maybe getting a 15-year mortgage or even a 10-year mortgage you hear advertised on the radio a lot. Or maybe they're just paying extra on their current mortgage. But, it's an uncertain real estate market for one thing. Property values are not really going up much at all. They're starting to a little bit, but your equity all depends on property value. There is no return on equity. So how do you get the best return on your money? Let's take a look at this and see, because you may want to rethink the way that you're spending your money and making your payments. Take a look here at a loan amount of $325,000 and see which mortgage is going to give you the best value. Is it the 15-year term, paying it off faster, building equity in your property quicker, or is it the 30-year term, much lower payment? Which is going to give you the best value for your money? Well, let me say one thing. I spent 18 years in the mortgage industry as a loan originator, mortgage broker, and I always advocated the shorter term loan if a customer could qualify for it. I always was under the belief that the faster you paid off your home, the better position you were in, the safer you were. You didn't have that mortgage payment hanging over your head. But guess what? I've been out of the mortgage business for about 6 years now, and I've come to understand after watching what's going on in the banking industry, come to the realization that that is not the best thing to do. The best thing to do is to get the biggest loan you can against your property, pull out as much equity as you can, and separate it from your house, because your house is what has the lien on it. And that lien is against the equity in your property. The more equity you have, the higher risk that you have, and the safer the bank is. Because they got a lien against your equity, you're putting them in a better position the more equity you create in that property. And the bank holds the keys to that account. If you want to get at the equity in your house, you have to qualify for it. And a lot of times, unfortunately, when you need it the most, you can't get it. Maybe you got laid off from a job. Maybe you got in an accident or developed an illness that you need cash for. You're not working now. Can you qualify? No. Okay, but if you separate the equity and put it in a private account, that money is accessible no matter what. You don't have to qualify for it. You don't have to fill out some long applications, have them pull your credit, check your employment history, none of that. So let's take a look here. Payment $21.86 versus $14.36. The other thing is, if you lost your job, which payment's going to be easier to make? $14.36, of course. Okay, that's a difference of $750 a month. Okay, $750 a month you're putting into the equity in your home with the 15-year. Let's see, if you took the 30-year and you took that $750 extra that you qualified for, and if you put it in a private equity account, now you could use that to provide tax-free funds for college tuition for your kids, to buy a car, for retirement, to take a vacation, maybe to remodel your kitchen or your bathroom. That's your money. You don't have to qualify for it. Okay, you can pay it back if you want to, and it's always best to do that, but you don't have to. It's your money. But if you pay it back over a period of time, you set the terms, you set the interest rate, basically. Okay, the account holder that you're taking the money from that's holding your account, they're going to charge you a low interest rate if you're borrowing money from that account. If you're borrowing, you can just make withdrawals and it's not going to cost you anything. But there are some advantages to borrowing that money. And I can get into more with that on a one-to-one level. Well, let's take a look. $750 a month going into a private equity account. And how does that build? What does it look like? So here we got the home buyer. Let's say he's 35 years old, and he's going to be making payments on a 30-year mortgage for 30 years. So for 30 years, he's going to be taking that extra $750 a month and putting it in a separate private equity account. That's $9,000 a year. So he's going to do that to age 65, and then he's going to stop. What happens at age 65? Well, of course, the house is paid off now, too. But after 15 years, the mortgage balance on that 30-year loan is down to $202,000. And the surrender value in his private equity account is $219,000. Now, can he take that money from his private equity account and pay off his mortgage if he wants to? Sure he can. Is that the best thing to do? I don't think so. Okay, but you can do that if you want to, depending on your situation. But let's say you let it go for another 15 years. You keep making these payments for 15 years, and now this individual is 65 years old. The house is paid off, and his account value now is $838,000. $838,000. That's a nice retirement account. Age 65, the homeowner now can take potentially distributions of $116,000 a year, tax-free, basically for the rest of his life. Tax-free. That's a nice supplemental retirement account. It's probably going to be a whole lot more than your Social Security, I would imagine. Okay? So your total contributions over 30 years, $9,000 a year times 30 years is $270,000. That's how much you put into this equity account. But because of the great rate of return that we get on these types of accounts, your total tax-free distributions that you receive to age 100 would be $3,938,000. $3.9 million. Now you put in $270,000, you've taken out $3.9 million. I'd say that's a pretty good rate of return. What kind of a rate of return are we talking about? Well, this is a blended account, indexed account. Okay, your principal is guaranteed, it grows tax deferred, and you can pull it out tax-free whenever you like. Unlike a government qualified IRA or 401k, you don't have to wait till you're 59 and a half. You don't have to start taking it out at 70 and a half with your minimum required distributions. There's no penalty if you take it out early. Okay, that money is yours. You can get at it anytime you need it. Over the past 23-year period, the historical compound average is 8.85%. Now that's pretty good. That's a whole lot better than most mutual funds out there. Over the last 15 years, I read that the average return on most mutual funds is about 3.5%. Because remember, you got to figure you got good years and then you got bad years. Okay, the market goes up, the market goes down, and most mutual funds are invested in the market. Most retirement accounts are invested in the market. And if you're putting money into your house, into the equity in your house, we've learned that that goes up and down too. So again, my name is George Fieldhouse with Vector Financial Solutions, and I like to say I'll work your assets for a firmer bottom line. So for more information on how you can set up your own private equity account, email me at vectorfinancialsolutions@gmail.com. Or you can go to my website for some more information. There's some other presentations and videos there. Goes into a little bit more detail on some other things. And that's at www.vectorfinancial.org. Thanks again for your time and have a great day.